Hello and welcome to a special installment of Liberty Nation Swamponomics videocast. I'm Andrew Moran, Ellen's economics correspondent. Will the Federal Reserve fight inflation, keep the bulls running on Wall Street, and allow Main Street to survive and thrive? The United States Central Bank is walking a tightrope this year as it tapers its pandemic-era $120 billion a month quantitative easing program and raise interest rates and potentially shrink it more than its $8 trillion balance sheet. But can the Eccles building maintain the euphoria that has engulfed the New York Stock Exchange over the last 2 years? As it pulls a trigger on a few rate hikes, it will either keep the economy together or it will burn the post-crisis recovery to the ground and flood the street in an ocean of red ink. To help us better understand what is happening and what could occur over the next 12 months, please welcome a special guest, Mr. Fergus Hodgson, the Director of Econ Americas, a financial and economic intelligence organization. Welcome to the program, sir.
Thank you, Andrew. I'm delighted to be with you.
So let's get started here. The expectation is that the Federal Reserve will end its asset buying program and then raise interest rates to combat inflation as early as the spring. But would this, let's say a 25 basis point rate hike, be enough to rein in 40-year high inflation?
No, not at all. In fact, it's almost laughable. I don't think they believe their own words when they postulate such an idea. So raising, the highest level I've seen is a projected four rate hikes over the coming year, and that would still mean a negative real interest rate of 5+%. So it's a bit laughable, really. It's such a minute change, and also, even if they were to reduce their balance sheet, it would only be by a small portion of the enormous explosion that has gone on over the last 2 years. So it's really just window dressing.
For viewers who don't know, back in the 1980s, when the U.S. had this type of level of inflation, the interest rates, or the benchmark interest rate, was about 15%. So right now, the Fed fund rate is about 0 to 0.25%. So what a huge drastic gap that is. So from what I've seen, speaking to strategists and watching the experts on the business news networks, it's that the Federal Reserve will need to juggle tightening to fight inflation while also sustaining economic growth and the bull market. Is this an achievable plan, combating inflation and growing the economy, considering how much liquidity has been pumped into the market over the last 2 years?
No, so great question, Andrew, because this is the very fundamental problem of the Federal Reserve, assuming we even have a central bank. But let's say we do. What we have is a Federal Reserve that has a dual or even triple mandate. Legislatively, the Federal Reserve is supposed to focus on inflation, employment, and moderate interest rates. And of course, these come into conflict. And it's a Keynesian assumption that you should have a central bank focusing on stimulating the economy. So no, and this is really, it's almost like the Federal Reserve has gone back in time and forgotten the modern wisdom of central banking, that since the 80s and especially the early 90s, most central banks have recognized, or did, that the central bank's exclusive focus should be on price stability, on restraining inflation, and all the rest should have no involvement in trying to manipulate the economy in one direction or another. And trying to expect the central bank to both restrain inflation and, let's say, stimulate or catalyze investment is silly. And it's a short-term, I hate to say, but a foolhardy approach. And it's also a mission creep that is unhealthy because it's not a democratic institution. And it favors the federal government, expansion of the federal government at the cost of states or at the cost of constituents. It also harbors or enables the federal government to keep spending beyond its means in a foolish manner. So no, it's not enough. And this observation that the Federal Reserve is basically tying itself in knots, trying to do too many things, it recognizes the politicized or the nature of the Federal Reserve that is not strictly towards economic stability, which is all that it should focus on.
Now, the debate among Fed policymakers is whether or not they will start shrinking the balance sheet sometime this year. If they do decide to unwind this more than $8 trillion balance sheet, what sort of impacts could this have on either the economy or the financial markets, considering how much assets it has purchased since the early days of the coronavirus pandemic?
Yeah, the simple answer is that we'll have a major correction across many markets, many asset classes. So the multiples or the valuations in the United States right now are at absolute record highs. So people are getting low returns based on the assumption of low interest rates. In order to, if the Federal Reserve were to pull back, obviously that would lead to a natural rise in interest rates or require it, and immediately those multiples would come down. So we see a major correction. As you might know, I host a podcast on precious metals, so I have an affinity towards natural resources or commodities. And so the inclination in an inflationary or unstable period is that commodities or precious metals, mining, all the alternative investments with lower betas or lower correlations with the broader market will perform better.
Finally, the Federal Reserve has been behind the curve on inflation, initially dismissing it and then claiming red-hot inflation is transitory. It now believes inflation will be elevated this year and then subside toward the end of the year, just in time for the midterm elections, of course. So is this a realistic forecast, considering that the monetary expansion that has taken place since the early days of the COVID-19 public health crisis?
It's not a realistic expectation. The Federal Reserve is using words as a policy tool. The federal officials are trying to change or manipulate our inflation expectations. The problem is they've lost credibility because all this transitory talk has just turned out to be a lot of rubbish. And the level of inflation has even surprised me, and I'm not exactly I'm not exactly optimistic about the US dollar. And so now that they've had basically 6 months of elevated inflation, despite all their talk about things being transitory, they're really in a bind. Now, the problem that the Federal Reserve faces is that Americans have changed their inflation expectations. They have built it into their projections, into their understanding of the future. And so that means that whereas in the past, inflation was more just negligible, wasn't so important, maybe it was a couple of percent per year, 1 or 2, now Americans will assume basically 5% plus for the coming year and years to come. And I don't see any reason why they'd be wrong to do that. And so the Federal Reserve is trying to turn that around because it realizes that these inflation expectations have consequences, and they make it much harder for them to control inflation without raising interest rates heavily. And this is where the political constraints on the Federal Reserve are becoming apparent, because it really doesn't have that great of an ability to raise interest rates without a huge political cost. And that would cause, obviously, great challenges for the Biden administration. It would cause problems for the federal government in general because of the interest or the payments required on the national debt. So they're trying to walk this fine line of saying inflation is not that big of a deal, it's going to go away, while also, I think, just realizing that the numbers are staring them in the face and they're looking foolish.
Thank you, Mr. Hodgson.
Thank you. I'm pleased to be on your show.
The Federal Reserve is not in the greatest situation, reigning in 4-decade high inflation amid an explosion of money supply growth and keeping the economy and financial markets afloat. But President Joe Biden is confident in Fed Chair Jerome Powell and his new right-hand woman, Lael Brainerd, in achieving its mandate of full employment, lower inflation, and growth. Considering that the more than century-old institution has, according to many economists and strategists, decimated its credibility, the Fed needs to plaster a banner in front of the Eccles building with "Mission Accomplished" next year. I'd like to thank Mr. Hodgson for appearing on the program, and as always, you can check my full Swamponomics column and videocast every week on LibertyNation.com. Thank you.
We're doing it for real, really real. Liberty Nation.
And Jeff Charles, contributor for LibertyNation.com.
I think we're starting to make an impact. Liberty style, fight for freedom.
The tracking poll sponsored by Liberty Nation for Thursday.
Mentioned by Dan Bongino, Rasmussen, Jordan Peterson, and
I
others.
can do it again if you want me to.
Cited in Mark Levin's American Marxism.
I think we're starting to make a really big impact. Get noticed. We're doing it. Rock on. I'm gone.